Hey there, hope you're doing great today. Why do we like secondary and tertiary markets is a question we've been discussing very frequently lately with current and prospective investors. But before we dive into some of the pros and cons, this is just a quick reminder that our videos are for educational and entertainment purposes only and do not constitute tax, legal, or investment advice. So let's begin. First of all, what are secondary and tertiary markets? Secondary markets typically have a population between 1 and 5 million. Anything above is considered a primary market, and anything below is considered a tertiary market. Some of the reasons why we like secondary and tertiary markets are less competition, ability to buy on a better basis, and higher potential for growth. That is not to say that when we choose those secondary and tertiary markets, we would sacrifice fundamentals like population growth, or job diversity. On the contrary, we study that even deeper and further in order to risk mitigate against any material market fluctuations. Which brings me to the second point, and that is some of the disadvantages of investing in secondary and tertiary markets. For one, they do have higher sensitivity to macroeconomic and economic fluctuations. There's more limited availability of data, whether that's on transactions that are taking place due to possibly and potentially lower volume of transactions. And last but not least, it may be more difficult to find strategic partners like vendors, contractors, property managers, and so forth, as those markets are indeed typically smaller. But historically, we have seen some pretty good results, at least within our portfolio, when very carefully selecting secondary and tertiary markets, and of course doing our deep standard diligence on that. So there may be a good reason why you may want to look into some of those locations. If you have any questions, feel free to comment below. If not, and if you found this video helpful, please like, share, and subscribe, and we'll see you at the next one.